Now, let's look at two key policies that drive the macroeconomics. One being the monetary policy, two is the fiscal policy. We know a basic understanding of these two, but yes, just to repeat what they are. Whenever I'm saying monetary policy, it is something that is implemented by the central bank of the country. So the Reserve Bank of India implements it in India, the Fed implements it in US, and every country has its own central bank which is implementing this monetary policy. So it is implemented by the central bank of the country, and the main task as a part of the monetary policy is to either increase or decrease the money supply into the economy. So whenever it's an increase of the money supply, it gets called as expansionary monetary policy, and whenever it is decreasing the money supply, we call it as contractionary. Of course, when we move along, we'll see what each of them typically mean. So, in short, monetary policy is something that is implemented by the central bank, and the main task of it is increase or decrease the money supply. And at the same time, whenever money supply is coming more into the system, means when banks are having more and more money, then the intention is they can lend them heavily. So an increasing in the money supply is also resulting in increasing of the credit in the country, and a decrease in the money supply will tighten the credit in the country. So, from a monetary policies perspective, we see that the central bank can go ahead either coming out with an expansionary policy or with a contractionary policy. The main intention, again, depending on the current state of the economy, the policy should target towards the economic growth as well as the stable prices within the country. So, stable prices is they have to control the inflation. So inflation at the same time bringing the economic growth. That is what would be the key objective of the policy. Similarly, the other important policy, fiscal policy, is implemented by the government of the country, not by the central bank. What does the government do? Here it plays around with spending. Spending is some kind of social spending it does. Probably it does the spending on infrastructure, roads, railways, the government's defense, government spends on various activities. So the different spendings of the government and taxation. Taxation is like a revenue to the government, right? How well the government is able to structure its spending and taxation to influence the economic growth. That is what we call it as a fiscal policy. What is the government's stance? What is the government's policy towards spending and tax collection? That goes as a part of the fiscal policy. So if the spending is more than the collection, obviously a deficit is going to be created. If the collection in the form of taxes is more than the spending, then the surplus is getting created in the process. So if the tax revenue is greater than the expenditure or the spending, a surplus comes up. If it is lesser than the expenditure, then a deficit is going to come up. And the objective of the fiscal policy also lies in terms of redistributing the income. Means charge tax from so collect from the rich people in the form of taxes and pass on the benefits to the poor in terms of welfare schemes. Spend with the poor in terms of welfare schemes by charging the rich in the form of taxes, which means there is a redistribution of the wealth and the income that is coming out as a part of the fiscal policy. So, on a broader scale, these are the conceptual aspects of these two policies. Now, before we go even more detail into each of them, because we'll try to deal with monetary policy to start with and then slowly move on to the fiscal policy. So, whenever the intention is talking about the money supply, monetary policy is more associated with the money supply. So, I really need to understand what is this money. What we could clearly see is money is today a widely accepted medium of exchange. We all know that. So for earlier there used to be barter. I give this particular item to you. You give me some other item. Right? I'll give you rice. You give me wheat. That's a barter system. But today, when we are talking about in terms of money, then okay, I'll sell you rice, you give me this much of money, these many dollars. I'll sell you wheat, you give me these many dollars. So the medium of exchange and a means of a payment, money is one of the money has created a kind of a revolution in the current days world, and it's a unit of account because almost every item, the price of it is expressed in form of money, not in form of anything else. It is expressed in the form of dollars, Indian rupees, currencies of different countries, but yes, at the end it is expressed in the form of money itself. So there is a common base that is set for all goods and services. And it's a store of value also because I can save it today to make a purchase at a future point. And from traditional definitions perspective, we keep hearing money is classified as narrow money and a broad. Narrow is purely the notes and coins which are in circulation and some kind of checkable bank deposits. But any other slightly less liquid assets that are being possessed, especially some kind of time deposits, money market mutual funds, all these things go more and more broader as a part of the broad money definition. And in some countries, even this narrow and broad is typically classified even more further. Like when we say M1, it's a very, very preliminary, highly liquid money, which is currency that is available with public, traveler's checks, which can be converted into cash immediately, demand deposits, again convertible to cash, and deposits against which checks can be written, checkable kind of bank deposits, which means the money can be withdrawn at any point in time. So these are highly liquid kind of highly liquid this is a highly liquid money, so that's where it gets classified as narrow. And in the broader, things keep slightly okay. There is a savings account, there are time deposits, money market mutual funds, debts with longer maturity, because here it may be a maturity of 3 months or lesser, whereas here we can talk about 2 years. So as the maturity period keeps going and going up, as the difficulty in terms of converting it into cash keeps going and going up, we see that the money categorization also differs. But on a broader scale, we can very well visualize the money as either a narrow one or a broad one. And typically, when I have to talk about the money creation process, where in the very earlier days, in the very age-old days, there used to be promissory notes. And that's the reason you see on good amount of currency notes, for some countries, you still see, I promise to pay the bearer. So that is, it is acting as good as a promissory note itself. A promissory note used to exist for storing gold and precious metals, and with just a promise which says that we will return your gold after a certain point in time. And there used to be some interest which the banks used to charge in for typically holding the gold and securing the gold. But in this process, okay, let's assume something like this. A, B, C. Different people have stored gold with the bank. So bank is acting as a store of gold and precious metals. Now, not all of them may withdraw it at the same time. They have stored it. They'll use it sometime later. They will not withdraw it at the same time, which means the bank is having this excess, this amount of gold, which it thought it can start lending out, at least some portion of gold. It can start lending out and create an interest out of it. That is what gave rise to the fractional reserve banking system, which is heavily observed in the today's world. A portion of whatever the gold or whatever the value of the metals that is there, it is lent to the other parties and interest came on that. So some portion of it has kept in the reserve because people can withdraw at any point in time. So to whatever extent they have visualized that people can withdraw, that has been kept in the reserve. Rest has been got into the lending process for some kind of an interest. So the borrower, now people have taken the loans. So these borrowers use this loan to make some kind of purchase, right, for consumption or for any kind of purchases. Now, so which means the seller of something received this loan amount. Now the seller can again bring the money into the bank. So it is a redepositing. And again for whatever amount that got redeposited, the bank can again do the relending process. Which means there is a cyclic effect that is going on, and whatever the initial amount of gold that was there, initial amount of money that was there, uh, using that much of money, the bank is able to create deposits which are in multiples of the original cash. Let me just give an example. Let's say $1,000 came into the banking system now, and let's say the reserve, the bank thought it will keep 10% of it as the reserve, means it has given loan for 900, and this 900 again came back into the bank because the person who has borrowed, he has purchased something, the seller has redeposited it in the bank. And for this again 10% it has set aside and it has given a loan of 810. Again this 810 came into the bank, and after 10%, 81 being set aside, it is becoming 729. So what I could typically see is the deposits wise, yes, there is a deposit of 1000, there is a deposit of 900, there is a deposit of 810, and so on. Now, like this, the cycle keeps continuing, which means the overall deposit that is existing with the bank, just with the $1,000 note, $1,000 that came in, the overall deposit with the bank, if I add up as a geometric progression, I can very well look at it as A upon 1 minus R 9 by 10.9. So this is creating $10,000. So the deposits are to the extent of 10,000 just by using 1,000 in the form of money. So this has given rise to a growth in the banking system, the fractional reserve banking mechanism. Deposits are typically in multiples of the original cash. So the overall money that got created in the process is 1000 rupees divided by the reserve requirement. We said 10%, so that's the reason we got it as 10,000. And the money multiplier is nothing but 1 divided by the reserve requirement, coming up to 10, or I could have created it as the overall money created divided by the original amount. So 10 times The original cash is the total deposits that got created in the banking system. So if the reserve requirement is going lesser and lesser, the overall money created is going higher, and hence the money multiplier is also higher. And this is where the quantity theory of money comes out, which says whatever is the quantity of money supply multiplied by the velocity at which it is used is same as the price multiplied by the real output. So if you look at it, price multiplied by the real output quantity is the total expenditure of the country. Right, in a particular period, this is the total expenditure, because we are talking of the price multiplied by the total real output, giving me the total expenditure of the country. And what this quantity theory of money says is this total expenditure of the country is equal to money supply, whatever money that is available in the country, multiplied by the velocity. Velocity is the typical number of times each unit of money is used for spending purpose. Now, the reality is the velocity, whatever it exists, changing it is a very slow process. So velocity may not change that heavily, and at the same time the real output also does not change that heavily, which means these are the real variables. Real output is purely is not a money based variable, it's a real variable. Velocity is also a real variable, which means these do not change that drastically. So which also gives rise to, if the money supply is increased in the system, if the money supply is increased in the system, the price also increases. Means there is a possibility of the inflationary environment getting created. So increase in the money supply, the prices can increase, creating an inflationary environment. Decrease in the money supply can tighten the prices, creating a kind of a deflationary kind of environment. So the real variables should not be impacted by the monetary variables. Here we see M and P are more related to the monetary variables, whereas the velocity of usage and the, see, money supply, so it's a monetary variable. Price, it is in terms of money, so it's a monetary variable. But output is not a monetary variable, it's a real variable. And velocity of using is also a real variable. So real variables should not be impacted by monetary variables, which is given by the fundamental of money neutrality. Right? So this is what is the basic of the money creation process, which we need to be comfortable with. Right? Now, we all need to understand what contributes to the demand for money and what contributes to the supply for money. When I am talking about the demand, it is purely from the customer's perspective, how much they are looking to hold in the form of money. Different individual customers as well as the firms. So to what extent they are demanding to hold the money rather than spend it. That is what is the demand for money. There are various factors that are typically affecting the demand. See, if the future transactions are going to be higher, especially if the real GDP is growing, I typically see that in the future many transactions are going to happen, so I want money. So people want to hold money rather than depositing it, because they are expecting some kind of future transactions to happen, because the economy is showing some signs of growth. They want to have money today. At the same time, they have a kind of a precautionary view about the future's unexpected needs. What are going to be probably some unexpected needs are going to come up in the future, if there is some kind of pessimistic attitude, yes, some new costs are going to increase. Some new expenses are going to come up in the future. When they are more and more looking at it from a precautionary perspective, they want to hold more money. Along with that, from even money can be held from a speculatory perspective as well. If probably the investment opportunities in future are going to be much better, there is some kind of an expectation. Let's say the government is going to come up with some kind of mega infrastructure project in a particular locality. Now, very close to that particular locality, we see that the real estate prices might take up into a completely new level. People want to invest in those after the announcement of the government. So, under the speculation that they can make big money, they can hold the money today without depositing, because even if they deposit it today, if they want to withdraw at a later point, it might become difficult for them to withdraw. So, they may prefer holding it in the form of money itself. So, if and also if the current returns are much lesser, they even try to hold it, because there's no point in depositing it today because the returns are much lesser, the interest rates are much lesser. So let's hold on, let's wait for a proper opportunity and try to invest it. The same logic is even implemented by the mutual fund managers as well. They hold some portion of the money in the form of cash with an anticipation that in the future some particular security will become more and more attractive and they would like to invest in that rather than trying to invest in some opportunity today. So, because of all these reasons, we see that people want to hold money rather than depositing it. And at the same time, if they are finding more and more risk with the current investment, they don't want to deposit today, they don't want to invest today, they want to hold it in the form of cash. Rather than losing heavy amounts, it's better that we hold it in the form of cash, identify a suitable opportunity, and then do the investment. As the interest rates are going lower and lower, the demand for holding money is typically increasing. Right? Now, on the other side, when I talk about the supply of money is typically done by the central bank. It is the sole independent authority to supply the money into the banking system or supply money into the economy. So it is supplying the money, it determines how much to supply, and one thing is it is completely independent of the interest rate. So which means whatever may be the interest rate, it is going to supply the same amount of money. The real interest rate, whatever it is, the money supply is going to be the same, which means the supply curve is perfectly inelastic or perfectly vertical. It is completely independent of the interest rate. And when we typically see the demand curve is more and more downward sloping, because if the interest rates are much lesser, the demand curve to hold money is much higher, because there's no point in depositing, we are not going to get any better returns out of it. But as the interest rates are higher, then the demand to hold money is much lesser, they would like to deposit more and more. So you see that it is a downward sloping kind of a curve. The lesser the interest rates, demand to hold more, and the more the interest rates, the demand to deposit more increases. And when I'm looking at the equilibrium, this is what will determine what should be the short-term interest rate. The equilibrium between that money demanded and money supplied will provide the short-term interest rates. So if the short-term interest rates are less than the equilibrium, people demand home money more and more, and slowly we see that the interest rates have to go up and go back to the equilibrium. And if the interest rates, short-term interest rates are higher than the equilibrium, again the interest rates have to go down because it creates excess supply. The interest rates have to go down. So increasing the money supply will decrease the short-term rate, and because if I am increasing the money supply to this, obviously the equilibrium is changed from this to this, the short-term rates are going down. If the equilibrium, if the money supply is decreased, obviously we see that the interest rates are going up, which means expansionary monetary policy, which is to increase the money supply, will decrease the interest rate, whereas a contractionary policy, which is a reduction of the money supply, will increase the interest rate, right? So this is one more important dimension regarding the demand and supply for money. Now, we really need to understand that whenever we are using the word nominal interest rate, we have to look at it with respect to real interest rate. It's composed of expected inflation as well as the risk premium, which means the inflation could keep changing year over year. Risk premium associated with the security could keep changing. So a simple way for us to understand is the real interest rates are more or less stable compared to the nominal, and this relationship is what we call as the Fisher effect. Now, when we talk about the central bank of the country, the key roles associated with the central bank, they are the sole authority to supply currency. They can back it by either gold or any other tangible assets, or even without any of them also they can supply the currency, which is what is called as the fiat money. They play an important role in providing banking services to the government as well as to the other banks. They regulate the banking system. They decide what should be the reserve requirement, what is the CRR, what is the statutory liquidity ratios. They decide the reserve requirements. They work on how much risk the commercial banks can typically take. So they implement the risk management. They are the ones who enforce the banks to implement risk management practices. Probably they bring in the Basel kind of standards and they make it mandatory for implementation for the banks. Then they also supervise the payment process, make sure that for any kind of domestic or international transactions, the amounts are getting settled in a very proper manner. And in case any banks face a huge withdrawals, people withdrawing huge amounts in small periods of time, which is creating a kind of a run on the bank to prevent that short-term run on the bank, to protect the banking system from losing in a bad way in the short term. It acts as a lender of the last resort. So it can print money because it has the authority to print the money. It can act as a lender of last resort. Along with that, it can hold gold. It holds foreign currency reserves of different countries, and it is the main entity which is implementing the monetary policy and also monitoring the same, coming up with the changes to the monetary policy. All these things are very thoroughly needs to be taken up by the central bank of the country. And coming to the objectives wise, one of the key objectives associated with the central bank is to control the inflation, bring about a stability in the prices in the range of 2 to 3%. They generally don't target 0% because a country like Japan Probably deflation is a very continuous problem, and even if the targeted inflation is around 0%, there is a very big chance that a deflation can come up, and deflation is always a difficult problem to deal with compared to the inflation. So generally, any country that is targeting towards controlling the inflation, they try to set the prices in the range of 2 to 3% growth. That is what they call as stability in the prices. Because even in countries where there is a high inflation, it will lead to high menu costs, because menu costs are associated with the companies. They revise their prices every year, every now and then, because the input costs are going up and up because of high inflation. Even the prices of their finished goods have to keep revising every now and then. Those kind of costs are menu costs. Menu is getting revised to a new prices. Their entire catalog is getting revised to a new prices because the inflation is much higher. And on the other side, we also talk about shoe leather costs, which are more from the perspective of the customers. They go to the bank, withdraw every now and then, because whatever the amount they have withdrawn, it is over, and still the costs are much higher, so they need to withdraw more and more, and the balances in the banks are typically falling. So that could be the consequences of high inflation. So the intention of any central bank is to control that inflation and bring about some kind of stability in the prices. Along with that, the central banks also target the exchange rate stability with respect to some currencies, at least with currencies like dollar, with euro. They try to maintain some kind of stability with their exchange rate. And what they typically do in this process is, when their domestic currency is appreciating, they sell the domestic currency. So more domestic currency is getting sold. Again, the price is the exchange rate is coming back. They are selling the domestic currency for the foreign currency. So more of sales happening on the domestic currency. The exchange rate is again falling. So it is coming back to the normal. And that's what exactly happens the reverse. When the exchange rate has depreciated, they are buying the domestic currency by selling the foreign currency, and again they are increasing the exchange rate. So they are targeting towards the stability in the exchange rates. Along with that, they also work on the interest rates and the economic activity. So, in the process of targeting the exchange rate, if they deviate heavily from the interest rates and economic activity, the volatility of the money supply is going to be a very dangerous problem. So, countries which are doing the exchange rate targeting, they have to be very careful that the interest rates and the economic activity don't go heavily volatile in them, because at the end they have to act according to the domestic economic criteria, not trying to target the inflation and other economic variables of that country against which they are trying to peg their exchange rate. See, one simple thing we said earlier, that whenever we are talking about the future exchange rate, right, future exchange rate, we are saying that the future exchange rate is dependent on the current exchange rate, spot exchange rate, along with that the interest rate differential between both the countries. Now, if the exchange rate has to be constant, which means it has to be purely dependent on the current exchange rate only, the interest rate differential should not exist. And interest rate again contains a component called inflation. So the interest rate differential can't exist. So the interest rate of the current country should be the same as the country against which the currency is getting pegged. The same logic goes with the inflation. So the country is typically acting as per the interest rate and the inflation of the country which whose currency against which the current currency is pegged, rather than trying to create a policy which is purely based on the domestic conditions. So unless the inflation rates and the interest rates of both the countries are same, this cannot be successful. Otherwise, the exchange rate will keep fluctuating. So, but some central banks do target the exchange rate stability as well. Along with that, the sustainable economic growth is one of the key objectives. The GDP of the country should keep growing at a constant rate. The full employment, the country should be operating at full employment level only. The unemployment is one area it needs to address, and at the same time it has an objective to set the long term interest rates at moderate levels, not too high, not too low, so that the economy goes in a balanced manner. So all these things come out as the various objectives of the central bank. Now, inflation, yes, it needs to be controlled, and the banks and the central bank and the various entities, even the government, they are fully bent upon in terms of controlling the inflation. And within that inflation also, we see some portion of it is anticipated, because even as a part of the targeted inflation, they say that we'll set it at around 2 to 3%. So there is some kind of targeting that is done by the countries and the central bank. So there is some portion of inflation that is anticipated, whereas the remaining is unanticipated. Whatever it is, inflation is something, if it is much higher, it is going to impact the economic activity of the country. But at least the anticipated is much better compared to the unanticipated. Because unanticipated, we'll see now that it becomes more and more costlier compared to the expected or anticipated inflation. Because whenever we are seeing anticipated also, any inflation for that matter, what we can typically see is when the inflation is going to be higher, means the prices are going to be higher year over year. Now, compared to holding money today, holding money here, holding money after 2 years, holding money for 3 years, the value of the money here, the present value is going to be much lesser, because inflation is higher, means interest rates are higher, the present value of the future cash flows is going lesser and lesser. So which means the cost of holding the money is becoming higher, and the purchasing power is also going down, because the present value of whatever I am going to get in the future is going to be much lesser, so the purchasing power is going down. But still, if it is unanticipated, things are even more worse. Unanticipated need not be on the lower side only, or only on the higher side. Even a lower inflation which is not expected also would create problems, because whenever we are seeing a volatile inflation, it's a kind of a risk. We don't know. Probably the interest rates could go up drastically, could go down drastically. So from a lender's perspective, we see that it is an additional risk. Because if the interest rate, if the inflation is high, okay, the interest rate is more than the expected. So real interest rate is more than the expected. Look at it. Borrower would have borrowed at an interest rate which is based on the expected inflation. So he has borrowed at an amount at an interest rate which is cheaper, because he has borrowed based on the expected inflation. Whatever the interest rate that is coming out, he must have borrowed at that rate, but in reality the interest rate has gone up because the expected inflation is much higher. So he is happy. If the inflation was much lesser, he would have ended up borrowing. He would have felt that he has borrowed at a higher, but now he is feeling that he has done the borrowing at a better rate, because now the rates are much higher. So the borrower is gaining and the lender is losing. But similarly, if the inflation was lesser, the lender is gaining, the borrower is losing. Overall, what we could see is if the inflation is volatile, it is creating an additional risk for the lender, so he would definitely be charging higher for that additional risk that he has taken, which is resulting in the interest rates typically going up, and as a result the investments are slowing down, the economic activity is slowing down. And on the other dimension, the reliability, right? So any kind of expansion the company may not be able to plan. See, supply and demand. Now, if the inflation is very high, right? If the inflation is very high, the company may think that it has got a very high return. But that very high return must have come not purely because of the business growth, but purely because of the price increase, because of inflation. Now, the company cannot do a proper expansion exercise because it paints a completely wrong picture to the company. So, the reliability with respect to the demand and supply can typically go up, and the decisions which people may end up taking would be more and more severe. And the magnitude and the frequency of the business cycles. So, recessions can come quite quickly, even the expansions can come quite quickly. So the business cycles are more and more frequent if the inflation is higher, is completely unanticipated inflation is higher. Otherwise, they could be more and more stable. So there are so many additional costs that are coming up because of this unanticipated inflation. So that's one of the prime reasons every economy targets in some form or the other. Every central bank targets in some form or the other to typically control the inflation. Now, the important tools that are available with the central bank to implement the monetary policy. What are the different ways the central bank can work around to implement the monetary policy? One, it can play around with the discount rate, typically called as the policy rate, or we even call it as the repo rate. So, how does it do that? This is that particular interest rate at which the commercial banks can borrow from the central bank, especially if their reserves are falling short on a temporary basis. They can borrow from the central bank, and whatever is the rate at which they are borrowing from the central bank, we are calling it as a discount rate or a policy rate. Now, the central bank can either increase that rate or decrease that rate. Now, if it is increasing, just try to imagine, if it is increasing the rate at which the banks can borrow from the central bank, obviously banks will stop borrowing, reduce borrowing, unless it is really essential, they don't get into the borrowing process. So because of this, the money supply in the market is going to go down, and which means they cannot typically lend also. So the lendings are going down, the money supply is going down, which is resulting in the interest rates typically going up, right? So a typical, in case they have lessened that discounting rate, discount rate or the policy rate or the rate at which the banks can borrow. So banks will trend to borrow more and more, because anyhow the interest rates are much lesser. They tend to borrow more and the more and more they borrow, they do more and more lending. So more and more lending happening, the interest rates have to come down. So the major, they can very well target the interest rates either above, up or down by just playing around with the discounting rate. And the way this agreement carries on is through a repurchase agreement or a repo agreement, where clearly the banks will sell the government securities to the central bank and the central bank pumps in the cash. So from the bank's perspective, they sell the government securities and the central bank is pumping in the cash. Again, the agreement is the banks have to repurchase their central government securities from the central bank by paying a slightly higher amount, and that higher amount is reflected in the form of interest that is being charged. Then the other mechanism which is available to the central bank is the reserve requirement. The the reserve ratio, it can very well set what proportion of the deposits should be retained with the central bank without doing a lending. So if it says the reserve ratio is 10%, which means 10% of every deposit that comes in should be deposited with the central bank. Only the 90% of that should go as a part of the loans, right? So the reserve requirement of 10% or whatever is the percentage that is set, that is the amount that has to be maintained as a part of the reserve with the central bank. Now, what could happen here? The central bank can either increase the reserve requirement or decrease the reserve. If it is increasing it, obviously, the banks have to deposit more with the central bank, so less money is available for lending. So the supply is becoming much lesser, which is resulting in an increase in the interest rates. As we have seen earlier, the money supply, the demand is going to be like this. The money supply, if it was here, the interest rates were something here. But if the money supply is going down, the interest rates are going to increase accordingly. So the amount that if the reserve requirements are set higher, the amount that is available for lending is decreasing and hence the interest rates have to increase. That's one way the central bank implements the monetary policy. And one more mechanism is it can get directly into the open market operations. Open market operations is buying and selling the securities just like a regular investor buys and sells them. In the open market, the buying and selling of the securities happen. So imagine if it is buying, it has to pay cash, buy securities, right? So paying cash means the banking system is filled with cash and resulting in a money supply increasing, which is resulting in the interest rates falling, and vice versa. If it is selling, which means it is giving the government securities and taking back the cash. Taking back the cash is resulting in money supply getting tightened, and the money supply is tightening is resulting in the interest rates typically going up. So the bank can either get into this policy rate controlling, increase or a decrease, or it can very well target on open market operation of buying and selling the securities, or it can really work around with the reserve requirements to finally bring about a change in the interest rates. But quite often we see that the open market operations are the most common tool that the banks get into on a regular or that the central bank gets into on a regular basis to plan out with the interest rates. Then this change in the interest rate, right? Any monetary policy bringing out a change in the interest rate through any of these mechanisms, does it really impact the price? Does it really play a role in terms of inflation control? Does it really influence the price? This is where, if it has been a money neutrality kind of a theorem, if it is applicable, changing the money, we have seen quantity theorem of money simply as saying money into velocity, money supply quantity into velocity is same as the price times the real output. Now, so money supply is either increased or decreased, and the price, we said that these two are real variables. So real variables should not be impacted with the monetary variables. So any kind of change in the money supply should have an influence on the price. So that is very clearly seen. But even in the real world, what we typically see is the moment a monetary policy has been implemented, it is impacting the lending rates of the banks. So if the rates are much higher, we see that the the consumption activity is going to go down, the investment activity is going to go down, which means the aggregate demand as such is going to go down. If the interest rates are much higher, the overall aggregate demand is going to go down, which is resulting in the prices also going down, because when we typically see supply curve not changing, the demand curve shifting to the left, we see that the prices also have to fall. Similarly, with respect to assets, if the interest rates are going up, the present value of the future benefit that the asset is going to provide is going to go down, which means the prices have to fall. Similarly, there could be an impact on the future economic growth. The current higher interest rates could create a pessimistic view of the future. The businesses may not be able to grow in future, expensive in future, so the prices have to fall. Similarly, we are talking anything that is resulting in a drop in the aggregate demand is going to impact the prices. Similarly, the foreigners investing in the domestic country, see if the interest rates are much higher, a lot of foreign capital keeps coming into the country, because the foreigners feel that investing in the investing in this country is much more yielding better returns. So results in more and more investment coming in. So more and more investment is they are trying to sell their currency and purchase the foreign currency. So which is resulting in the domestic currency getting appreciated. So an appreciation of the domestic currency is reducing the demand for exports, which is again resulting in a drop in the aggregate demand. So the monetary transmission mechanism is clearly bringing out different ways in which we can link the monetary policy with the inflation. So that is where the central bank really targets the monetary policy, because it expects, these are not signs, these are purely based on the expectations. So that's the reason in some cases it can very well backfire. It may not give the desired result, because it's not a science that if this happens, this has to happen. These are more and more empirical in nature. So what we typically see is all these things are possible, whereas in some cases they may not work out as well. And whenever we are talking about central bank, if it has to be more and more effective, it has to be more and more independent, because the key objective of any central bank is to come out with a very effective policy which is going to target inflation, which is going to bring about economic growth, while at the same time maintaining the unemployment, interest rate levels, etc. under control, along with the exchange rate. So if it is more and more independent without any political interference, it is going to be more effective, because it's a very common practice in many countries that the government which is in power will influence the central bank and really affect the independence of the central bank. They try, see, in some cases what could very well happen is the central bank may come out with a contractionary policy. What happens when it comes out with a contractionary policy? It reduces the money supply. Money supply is reducing, the interest rates are going to go up, right? And at the same time, or if it has come out with an expansionary policy, the prices are going to go up. Money supply is increased, So the prices are going to, it can result in inflation. And what could very well happen is if the interest rates are getting increased. So if they, when will the interest rates increase? Probably when the money supply is lesser, the interest rates are going to increase. And when the interest rates are going to increase, yes, probably people are going to save more and more but consume less and less. So aggregate demand is going to fall. And if the aggregate demand is falling, you see that the output is going to fall. So the real output is falling, which means the economic growth is typically falling. Economic growth is falling, unemployment is going up. Now, this is what could be a problem for the ruling party, especially before the elections. So, they may not want any kind of contractionary policies to be implemented by the central bank just before the election. So, which means they are trying to interfere in the activities, and the central bank typically doesn't have any level of independence on this. Even if they say there is an independence that is offered to the central bank, we see in large number of countries the heads of these various operations are appointed by the politicians itself. So we really need to understand again, even if there is an independence, is it an operational independence or a target independence? When we are saying the operational independence, the policy rate they can set and implement independently. But when we are talking about the target independence, they can set the target for inflation, they can come out with a process to achieve it, and in what time frame they are going to meet the target. So that's a very huge independence compared to operational. And what we see is majority of the central banks across the world, they have only the operational independence and not the target independent. But whatever it is, the higher the independence level that is associated, that is given to the central bank, the more effective it is. Along with that, the central bank has to be more and more credible. Whatever the policies that it has stated, whatever the targets that it has stated, it has to be continuously on a mission to achieve those targets. That is when people will start trusting them, and the reliability of the central bank typically goes up. And transparency, another important dimension, because whatever the targets they have set, whatever is the measures they wanted to work on, the communication or reporting of those things should happen on a regular basis, which clearly discloses the state of the economy, whatever the economic indicators they have used as a measure, how did they perform till now, what has been their trend, what is the expectation regarding the performance of them. A continuous detailed performance reporting is very much required to keep the central banks more and more effective, right? Then we can see that monetary policy can impact the different variables, different economic variables in different ways. Let's assume that the country has come out with an expansionary policy. This expansionary policy resulting in more and more money supply coming into the banking system. So the banks, they are having excess reserves. So they want to lend. So more and more reserves with the banks. The interest rates, the lending rates are typically going down. So if the short term rates are going down, then generally the long term rates also have to go down, because long term rates are a function of the short term rates. So short term rates have gone down, the long term rates also can go down, and and on the other side it's also resulting the currency wise, if the interest rates are going down, the domestic currency also depreciates, because foreigners will not show any kind of interest to invest in the country. So the domestic currency is going to depreciate, and because the interest rates are much lesser on the other side, the loans are going to be much higher. So the business investment is going to be much higher. Businesses are going to grow. Similarly, consumption is going to go up because people don't want to invest because they're not getting much returns. So overall, I see that the aggregate demand is going to go up, which is resulting in the price going up. Because when I say that the aggregate demand is up, we see that both these things are going to go up, means price is going to go up, the real output, which is the GDP, is going to go up, and even the employment levels are going to go beyond the full employment level. So one expansionary monetary policy, it is really having an impact on almost all the economic variables, right? We also have seen that the asset prices can increase if there is an expansionary policy because the present value of the future cash flows is going to increase. Banks, they adjust their lending rates for short term and long term separately. The domestic currency depreciates, which is again resulting in the demand for foreign goods. Sorry, the demand for exports. Exports are going to go up, imports are going to go down, which is again resulting in aggregate demand increasing. Further rate increases, right now the interest rates are lesser. People can still expect that in future the interest rates are going to decrease even more, which could result in more and more investments in the business. So all these things can really play an important role with a monetary policy implementation effectively. And in general, as a part of the monetary policy, the central banks, they target either the interest rate, so they want to keep the interest rate in a specific range. If they have gone above the target, they increase the money supply. If they have gone below the target, they decrease the money supply. A very straightforward way as a part of the interest rate targeting mechanism. But the most common mechanism we see in the today's world is the inflation targeting. They try to set the inflation in the range of 1 to 3%, and generally it's the future inflation, not the current inflation, because current inflation is coming up because of the various activities that have been implemented in the past and they cannot change those activities, so they don't want to work out on the current inflation levels. But generally it is the targeted inflation. Let's say 1 year down the lane, 2 years down the lane, the inflation should be around this region. So they are going ahead with inflation targeting mechanisms, and they generally don't want to target the 0% because of a possibility of a negative inflation or deflation, which is much more difficult to control compared to the inflation. And there are a few countries which are going ahead with exchange rate targeting, wherein they simply get into using their foreign reserves to purchase the domestic currency, or sell the foreign reserves, or sell the domestic currency for foreign currency. Either of the ways, they try to do a transaction with the foreign currency, and typically either increase or decrease the exchange rate so that it lies in a particular level. And because of that, it leads to higher volatility, because important thing is they deviate from their domestic economic circumstances. As I have said earlier, only when the inflation and the interest rates of both the countries are more or less similar, the exchange rate cannot be targeted to be in a particular range. And to keep these things in line with the pegged currencies numbers means in the domestic currency, lots of volatility can happen with respect to money supply, right? And at the same time, it might very well be possible that the foreign reserves can completely run out, which can lead to not being able to sell the foreign currency to the required amount to bring the exchange rate within the levels. But the major problem lies in deviation from the domestic economic circumstances, and the monetary policy of the country will be in line with the pegged currencies country, not with the domestic country. So that becomes a very important problem, very severe problem, which needs to be addressed by the central banks. And whenever we are talking about expansionary, See, any policy rate, if it is more than the neutral rate. What is this neutral rate? It is the growth rate of the money supply that does not change the economic growth. Economic growth is not volatile. It does not increase or decrease beyond a certain point. So wherever we are talking about that amount of money supply on an annual basis or on a periodic basis, which does not either result in a fall in the interest rate, fall in the economic growth rate, or a growth in the economic growth rate. More or less stable economic growth, whatever that particular rate of money supply, which is resulting in a stable growth rate, is what we are calling as the neutral rate, and it is typically expressed as real trend rate growth of economic growth plus the targeted inflation. And whenever we are talking of real trend rate, it is the long term sustainable growth rate, which is not observed directly. It has to be estimated from the data, and it can keep changing over time. But whenever we are saying that the policy rate is above the neutral rate, we call that as a contractionary policy. Otherwise we can treat it as an expansionary policy. And in another important dimension is monetary policy needs to be adjusted to reflect the source of inflation, not just the inflation number. Because whenever we see, okay, a very interesting part, this is the aggregate demand, this is the aggregate supply. Okay, let's assume that demand has gone up, aggregate demand has gone up. So this is resulting in an inflation, prices are up, right? And in this case, coming out with a contractionary policy is much better. If the demand has gone up and the inflation has gone up, when we are getting into a contractionary policy, what is going to happen? The interest rates are going to go up, money supply is reduced, interest rates are going to go up. If the interest rates are going to go up, what is going to happen? What is going to happen to the aggregate demand now? If the interest rates are going up, the consumption levels are going down, the investment levels are, if the interest rates are up, the consumption levels are down, interest rate levels are down, overall resulting in the aggregate demand coming back. So a contractionary monetary policy is much more apt because whatever was the aggregate demand that has increased, it is going to come down. Whereas, let's look at a slightly different scenario. Let's say the inflation came up not because of increase in demand, but because of a decrease in the aggregate supply. Why is this aggregate supply came down? The input prices have gone up, right? And now in this case, when I am looking at the inflation coming up through this way, which is a cost push inflation. This inflation was a demand pull inflation where aggregate demand has increased and it has resulted in the prices going up. Whereas here, the prices have gone up because of the supply shock. Now, in this case, if the country tries to look out for a contractionary policy, yes, the aggregate demand has to come back. Now, we could see if the aggregate demand is coming down, okay, it is able to bring down the prices, but what we could see is it is still bringing down the economic growth. The economic growth of the country, the employment level of the country is getting fully hampered, whereas here that's not the case. So, depending on what is the source of the inflation, is it a demand pull or a cost push inflation? The monetary policy of the country should be targeted. The same contractionary policy could give us a better result if it is a demand pull kind of an inflation, whereas it can really have a negative impact if the inflation is because of the input prices typically going up, right? And whenever we talk about the monetary policy, it comes out with a package of limitations as well. Some of the things, the long-term rates may not be in line with the short-term rates. One of the important aspects, because See, in general, earlier we have talked about the long-term rates are a function of the short-term rates. But here we are saying the long-term rates may not be in line with the short-term rates. Simple. Let's say the country, the central bank has come out with a contractionary monetary policy. So it has reduced the money supply. So money supply has reduced, which could, because it has reduced the money supply, the interest rates are going to go up, right? Money supply has reduced. Okay, let's plan it out. The supply got reduced, so resulting in the prices typically the money supply. The supply curve is shifted to the left. The interest rates are going up and it can increase the inflation. But if people feel that the inflation comes down because of the contractionary monetary policy, right now they can go up, and the moment the interest rates are going up, right, you could see the other way, the interest rates are going up, and if the interest rates are going up, people try to consume less, invest less, which is resulting in the inflation typically coming down. And if the inflation is down today, in future it could go even more lesser, because people may start believing that the inflation can go much lesser in the future, and we know that the returns on the long term are a portion of even the inflation risk premium is typically bundled. So if the inflation is going to be lesser in the future, the long term rates can be much lesser. So in the short term, the rates are going up, but in the long term, the rates can fall. That is where the monetary policy is typically failing. Or some opposites can occur between the long term rates and the short term rates. Similarly, look at the contractionary policy. If it is more and more contractionary, it can even be perceived that the recession can go up, because the more and more contractionary the monetary policy is, the interest rates are going, money supply is going to go down drastically, right? The money supply is planned to go down drastically, the interest rates are going to go up drastically, the consumption levels are going down drastically, and the investment, the economic growth is getting hampered, so possibility of recession is going to come up. And once there is a kind of a perception that the recession is going to crop up in the near future, compared to the short term, the long term bonds become more and more attractive, which means the long term, because of more demand for the long term bonds, the long term interest rates are going to go lower and lower. So the short term interest rates could be higher, but the long term ones could go lower because of this. And in case this central bank is able to maintain the inflation target, obviously this may not be a big thing to consider. Then there is a possibility of a liquidity trap, which simply says, yes, even if the short term rates are not falling, people don't want to deposit the money. They want to hold it in the form of cash. So the demand for money is very elastic. No one can do anything about it. And even then, any kind of a monetary policy, contractionary monetary policy, may not result in the or expansionary monetary policy cannot result in changing the interest rates at all. So the individuals are just holding money even if the short term rates are not falling, which is what is creating a liquidity trap. Even that dimension needs to be understood. And as a part of the inflation targeting, it should not go so worse that deflation is going to come up, which becomes a very painful thing to handle. And probably the recent credit crisis of 2008 gave rise to another scenario. Today we see that the money supply is higher, short term rates are very lower, but still banks are not willing to lend because their equity has gone down drastically, so they want to regain that equity as a part of that credit bubble that has occurred in 2008. They have lost all their equity, so they want to get back, which means right now they are unwilling to lend even if they are having higher and higher reserves. Now it is becoming a headache of the central bank to typically motivate them to lend more and more and create enough reserves in the banking system, because they are perceiving a threat of deflation because of the poor economic growth that is still continuing in majority of the countries. So the central banks of the countries have really thought about and came out with a new mechanism called quantitative easing, where they are getting involved in terms of pushing the money supply into the market high enough so that the banks feel more and more comfortable in terms of lending, and also create a confidence in the borrowers with respect to borrowing, and again get back the system running in a much better manner. And especially for the developing economies, implementing the monetary policy is very difficult because deciding on a neutral rate is very difficult. Why the neutral rate is difficult? We said the neutral rate is a real trend rate of economic growth plus the targeted inflation. First of all, a developing economy, economic growth cannot be a stable number, and the targeted inflation also may or may not be met, which means determining a neutral rate is a big challenge. So implementing a proper stable monetary policy is going to be much difficult in a developing economy. And just to talk about the quantitative easing, which has been a response to the the commercial banks not showing any kind of interest in the lending, even though their reserves are much higher because of the threat of the deflation and the economy not picking up. The central bank typically is purchasing the government bonds, increasing the money supply, generating the excess reserves into the banking system, and at the same time reducing the interest rates to encourage the borrowers to get into the borrowing process. So this is a kind of a mechanism where the interest rates are set at an extremely low levels to encourage the borrowing, and along with that we also see that the central bank is purchasing more and more government securities to pump in more capital into the banking, more supply into the banking system, so that they get confidence enough to get into the lending. So overall, the central bank is coming out with the mechanism of encouraging both the borrowers as well as lenders to get back into the normal groove, so that the economic activity of the country can be improved in the times to come. Now let's move on to the fiscal policy, where we have initially discussed that it is primarily the usage of the government spending and the taxation to influence the economic activity in the country. And if the spending is more and taxation is collection is lesser, obviously there is a deficit that is getting created, and the government spending is increasing, means the aggregate demand is going to increase. So the demand curve is going to shift to the demand curve is going to shift to the right, which is resulting in the prices going up along with the output going up. So the economy is growing, the unemployment levels are coming down because the employment levels are going up, and a very important tool, especially when the economy is working below the full employment, because the employment levels are going to go up. But if it is operating already at a full employment level, it's just resulting in the prices going up. So in some cases it may not be a good tool, but if it is really operating in below the full employment level, probably a very powerful tool which can bring back the employment levels. And this is where the Keynesians really think that when the economy is operating at less than full employment, A good fiscal policy, increasing the government expenditure is really going to increase the aggregate demand, which is going to push it to the right, which is resulting in the economy coming back to the full employment. Whereas the people who advocate the monetary policy, they really believe that whatever is the fiscal policy that is implemented, the impact is more and more temporary, and a monetary policy is a very must, wherein they have to really either come out with an expansionary or a contractionary kind of a monetary policy. Fiscal policy cannot really play an important role in terms of building up the economic activity of the country in the long run. And when we are talking about the fiscal policy, there are two ways in which we can look at it. One, there are automatic stabilizers, which are like built-in fiscal devices, which are automatically updated. Whereas when we are talking about discretionary, it is purely the decisions that are taken by the government to stabilize the economy. And coming to the fiscal policy, some of the major objectives lie in bringing out in really coming out with a stable economic activity, ever growing economic activity. They control the level of aggregate demand. It should really target towards redistribution of wealth and income tax from the people who have more and distribute it to the people who have lesser. So redistribution of wealth and income and proper allocation of the resources come as some of the key objectives of the fiscal policy. And what are the different ways in which the government can get into the implementation? Either it can do spending or it can do the revenue collection taxes. So spending, some kind of spendings it can do transfer payments, it can provide benefits as a part of the redistribution, collect taxes from the rich and do some kind of welfare payments. Transfer payments come as unemployment benefits, or they could talk about social security kind of benefits, different kinds of schemes, medical benefits to the employees, to the citizens. So it can provide some kind of social schemes, welfare benefits, pension benefits to the various citizens. They work as a part of the redistribution of the wealth, and because it's not something that is earned during the particular year or during the particular period, it's not produced, it's not included as a part of the computation of the GDP. But the main intention of the transfer payments is to provide a minimum standard of living for a person who is unemployed, giving some minimum amount so that he can so that he can live a decent life. Or if someone is fully ill, some kind of security from the country in terms of securing his health. So these are the things which ensure a minimum standard of living. Government can get into the current spending on various activities, but along with that, it can very heavily get into a capital spending. It invests in infrastructure, roads, defense, right? It comes out with parks, schools, hospitals, lot of things the government can invest in, which will increase the future productivity leading to the economic growth, and it's a kind of a benefit to the entire population. So the government can come out with good spending tools which can increase the aggregate demand and which can even create employment opportunities in the future. Along with that, it can play with the revenue tools. The revenue tools are some kind of collections. So there could be direct taxes on the income, wealth of the person. And along with that, there could be indirect taxes on the goods and services. There could be a service tax, there could be a sales tax, there could be a central excise duties, different kinds of taxes which are levied on the goods and services. There could be an income tax, there could be a corporate profit tax, which are directly levied on the entities itself. So different kinds of taxes can generate revenue, different kinds of spendings can generate expenditure, and the government has to plan the budget, deficit, and surplus accordingly. And the social policies can very well be implemented through the indirect taxes, especially if it really wants to people to reduce the consumption of alcohol. So an alcohol bottle, it can really set a very high tax rate. Or suppose if it wants people to reduce tobacco, it can really tax very heavily on the tobacco production, tobacco sales, so that people will slowly start reducing the quantum of usage and the businesses can go down. The same logic, even so, which is resulting in the revenues typically going up without any kind of addition to the costs. But obviously they have their own frame of disadvantages also, because any of these schemes, transfer payments, they have their own time for implementation. One, they have to be collected. Two, they have to be distributed. They have to be planned. So there is an ample time taking. These are all ample time taking activities. So the government has to really make sure that it is able to implement them effectively in a pre-specified time frame. Even the direct taxes, collecting the taxes is going to be a very big time taking activity. And on the other side, capital spending is going to be even more time taking, because it has laid the roads, it has laid the school, but it provides the benefit. That particular school will provide the benefit only after a long period of time, because initially there is a huge construction period. After that, people have to join, people have to study for a few years, and only the benefit of that school is going to come up at much later point in time. So that's one drawback that comes out with the fiscal policies, especially with different kinds of spendings and payments and the revenue collection mechanisms of the government. And whenever we are talking of any good tax collection policy, the different items under it, they should be simple to use, understand, implement. They cannot act as a deterrent to work. Very important point here. The taxes should not be so high that people feel demotivated to work. Why should I really work? The tax is so high. I'm not left with anything bigger. So the motivation levels are going to go down. So they should really take care. The good tax policy should take care that people don't go demotivated. There should be at least something like a horizontal equality maintained. People in similar situation, they should pay similar taxes. Some should not pay much higher, some should not pay much lower. Along with that, there should be a vertical equality, which says the rich should pay much a higher tax compared to the poor. And whatever is the tax policy, the government should set it in such a way that the revenues are sufficient enough to meet the spending needs of the government. And any changes in the fiscal policy, right? If at all we are expecting that in the future taxes are going to be up, people are going to stop consumption today. The aggregate demand is falling. The aggregate demand is falling, immediately resulting in the prices coming down. So inflation is getting controlled. And the tax reduction, generally people who are already there in the high tax bracket, even if the tax is reduced, they may not consume anything more. Their consumption levels may not change that drastically, because they have been consuming things to the fullest, even though the tax is higher, because they have that additional personal disposable income. But people who are in the lower income levels, lower tax brackets, by a reduction in the tax, they are really getting benefited. Only for them the consumption is increasing, which means aggregate demand is increasing only for the lower income people, not for the higher income ones. So the government has to be very careful in the implementation of the fiscal policy. It can't really think that a reduction in the taxes is going to increase the aggregate demand heavily. It's going to increase the aggregate demand only partially, because the benefit is going to come only for those people who are having lower incomes compared to those who are having higher ones. Then the other dimension to look at, just like we have seen a kind of fractional reserve banking system where we have looked at the money multiplier, which is defined as the amount of number of times the deposits are above the original cash. Even in case of fiscal policy, we talk about some kind of a multiplier. Let's say the government is spending some $1,000, right? So the government is spending $1,000 per every individual. So overall, let's say the government has spent some $1,000. Now this 1,000 is going as additional income to the individuals. Additional individuals' income is increased by 1,000. So let's say they are paying a taxes of 20%. So it's as good as their additional income has gone up by 800. 20%, let's say they have paid the tax. So the income has gone up. Now their consumption, now the income has gone up. The personal disposable income is 800 for them. Now out of this, they can consume something, they can spend something. So let me assume that 75% of it is consumed. So the marginal propensity to consume is 75, marginal propensity to save is 25%. So let's say they are want to consume 75. So their consumption is up by $600. Right? Consumption is up by 600, which means aggregate demand has actually gone up by 600 more, 1,000 as well as 600. Now, the same 600 that came up as a part of the aggregate demand, again 600 is being paid from one party to the other party. So the other party who has received the 600, he will pay some tax out of it because he has received that 600 extra. He is going to pay some tax out of it. So let's say the 20% tax he has paid, so he can consume, he is left with income of 480, and again assuming 75%, he can very well consume 360. So his consumption is again up by 360, which is resulting in the overall aggregate demand increasing much more than 1,000. And that is what we are calling as the aggregate, that is what we are calling as the multiplier. Now if I see here, initially it was 1,000, after that it has generated 600, after that it has generated 360. Overall, if I see the calculation, the overall amount that it got generated, the aggregate demand got increased for the 1,000 that is invested by the government is going by 1 minus 0.6. So 1,000 divided by 0.4 resulting in 2,500 bucks. Now the way I can simply compute that is nothing but 1 divided by 1 minus of marginal propensity to consume is 0.75 and 1 minus tax rate is 0.8. Right, so it is coming out as 1 divided by 1 minus 0.6, it is coming out to 2.5. So the multiplier is coming out to be 2.5, which means a $1 increase in the government spending is resulting in a $2.5 increase in the aggregate demand. So aggregate demand is increasing much higher compared to the spending that is being done by the government, and that is what we call as the multiplier, the fiscal multiplier. Probably I call it as fiscal multiplier, and in this example I am taking the fiscal multiplier as 2.5. And what we could clearly see is as the tax is increasing, 1 minus tax is decreasing, right? Tax rate is increasing, 1 minus tax is decreasing. So this multiplier is decreasing, 1 minus multiplier is increasing. So 1 by the increased value is decreased. So AD decreases if the tax is increased. Tax is increased, we see that the multiplier is going to decrease, Whereas if MPC is increased, marginal propensity to consume is increasing, the multiplication is increasing, 1 minus multiplication is decreasing, and 1 by decrease is increasing. So the multiplier, if the MPC, marginal propensity to consume, is increasing, we see that the multiplier is also increasing. So that's where we see it is inversely related to the tax rate and it is directly related to the marginal propensity to consume. Similarly, we are looking at a government which is spending $1,000 for the same example, spending $1,000 where the tax rate is 20% and the marginal propensity to consume is 75%. Now, if it is taxing, right, it has imposed, let's say, $1,000 tax. Now, what is happening? The $1,000 along with, let's say, $1,000 spending, it is creating a $1,000 tax also. If it has created a $1,000 tax, obviously the person is going to because of the tax rate that is available, our propensity to consume will go down by $1,000, but out of that he is consuming only 75% of it, which means it is going down by 750 only. So 250 is the down, right, out of that 1,000. So which means when I go with the multiplier effect here, I am looking at this whole value, whatever the extent it is going down, the 750, out of that 750, again a 20% tax rate. What we could typically see is the magnified effect that is coming on the aggregate demand, and we see that if along with the tax rate, along with the reduction is 250 here, whereas in the earlier case the reduction was by 400, which is resulting in, see, earlier it was resulting in 2500. Now 750 doing a multiplier by 2.5 is resulting in 1800 and whatever, 750, 875, resulting in a positive value of 625. So we see that the balance budget multiplier is always positive. Rather than that, if the government has spent $1,000, the tax that it should collect is 1,000 divided by the MPC. Marginal propensity to consume is 0.75. So what we are saying is if it has charged a tax of 1,333, then what we are saying, the marginal propensity to consume is 75. So the aggregate demand is going to go down by 1,000, and multiplying it with a multiplier of 2,500, 2.5 overall, resulting in an aggregate demand going down by 2,500, and the government spending resulting in a 2,500 overall, resulting in AD growth of 0. So the taxes need to be increased for every dollar that the government has invested or spent. It should charge taxes as $1 divided by the marginal propensity of consumption, so that the net growth in the aggregate demand is 0. Otherwise, we see a positive growth in the aggregate demand even if the government spending and tax, both of them are applied at the same rate. That's one important thing that we really need to keep in mind. Then another important point in this dimension where we have to get a hold on is the Ricardian equivalence. Let's say the budget deficit is very high. What do we mean by that? Government spending is very much greater than the taxes. So if the deficit is very high, it means that taxes are much lower today. And this deficit has to be filled sometime. So in the future, the taxes might go up drastically. And with that kind of an intention in mind, people will stop consuming today because they have to pay more taxes in the future. They'll start saving more today. But if they are saving only to the extent of the principal and the interest repayment on the debt which the government has taken, it may not impact the aggregate demand at all in the future. That is where the Ricardian equivalence is coming into picture. Then, the another important dimension is the debt of the country, right? In some cases, the debt of the country is much higher in comparison with the overall GDP. As a proportion of the overall GDP, it is a very significant number, whereas in some cases it could be much lower. Now, the discussion that goes on is, if that percentage is much higher, is it really a concern or is it not a concern? Some people say yes, it's a big concern. Let the debt, proportion of debt as a percentage of the GDP, it should not be that high, because in the future, right now, okay, because the debt is much higher, in the future, the taxes could be much higher. And if the taxes are much higher in future, people will be demotivated to work. Why should I work if I have to pay more and more taxes? Why should I work? This incentive to work comes up, and which will have big impact on the economic growth. So the country has to handle the ratio quite effectively. The size of the debt cannot be significantly higher in comparison with the GDP. And when the debt is very high, whatever the deficit that is getting created, it may not be financed at all. New financing cannot come out if the debt is already very high. And as the borrowing is increasing in the government sector, so if the see, look at it like this: the government is borrowing more and more, and if it has to borrow more and more, it has to pay high interest, right? Because more and more borrowing can happen at higher cost only. So it has to pay high interest. If the government borrowing itself is having a high interest, the private borrowings should be more riskier than government. So the private borrowing should offer even more higher interest. Now at that higher interest, the private may think it's no worth in borrowing at that higher rates and doing business. They may exit out of the businesses. So the economic activity gets very badly impacted, and that is what we are calling as the crowding out effect. The crowding out effect is going to develop quite drastically, and that is where some economists talk about the proportion of the debt, the size of the debt as a proportion of the GDP should not be much higher, and it's a big concern to the growth of the economy. Whereas there is another school of thought which talks about the size of the fiscal deficit is really not a concern at all, because to a large extent they feel that the debt can be financed through the taxes that are getting collected, and the deficits can boost the productive capacity. They are very optimistic. Okay, now there is a deficit, so the productive capacity of the country typically goes up, because people will be of the feeling that if they don't work, they cannot typically grow. So they are going to boost the productive capacity. Innovations are going to come up only during that particular point. This is looking like a very optimistic way of looking at the economy. And fiscal deficits, they bring out lots and lots of tax reforms, and they are also advocating that Ricardian equivalence may prevail, because whatever is the private savings, they keep rising, because they assume that the taxes are going to go up in future, so they reduce the consumption, they reduce the investment, they keep saving more and more in the anticipation that they have to pay more taxes to repay the debt and the interest, the principal and the interest portions of the debt of the government. Right? And if the economy is already operating below full employment, whatever is the deficit, that does not crowd out the private investment, because private still sees an opportunity, but only when the economy is operating at full employment, this crowding out effect is going to occur on a bigger pace. So there are some sections of people who are arguing that the size of the fiscal deficit is a real concern, whereas on the other side, we see that people are arguing that it is not a real concern as well. And coming to the implementation of the fiscal policy, first of all, it's not a science. So, because it is a relationship between the variables, there is a very good possibility that the forecast might be wrong, which can result in the policy decisions also getting implemented. So, it's not a scientific stuff. We have to understand it. But the key problem with the fiscal policy lies in the delay in implementation. And even if they are implemented, delay in observing the results. Result of the fiscal policy, the outcome of the fiscal policy takes quite a significant amount of time to be observed. So overall, we see one, recognition lag, policy makers having problem in terms of understanding when should a fiscal policy change need to be implemented. Okay, so once they have recognized, action takes some time because they have to really vote, they have to really hold meetings, they have to really plan. So there is some kind of a time lag for action itself, implementing it itself. And even if they have implemented some kind of decisions like capital spending decisions or tax collection decisions, they may take quite a long period of time to show some kind of impact on the economy. Even if we are looking at a fiscal multiplier effect, the moment the government spends, it takes some time. It takes some time for the people to do the consumption for that amount, and that consumed amount again reaching the seller, that seller again paying taxes. It's going to take huge amount of time for that fiscal multiplier effect to typically take shape. So there are some difficulties, and other practical difficulties come out with how do I measure what is full employment level? There is no objective measure of what is the full employment level. And we are also saying that if the economy is not operating at a full employment level, fiscal policy will have its own dangers, right? So expansionary fiscal policy is good, right? Because fiscal policy is going to shift the aggregate demand, which is going to increase the real output along with the price. So if the economy is already at a full employment, the real output employment increase is of no good use, which means only inflation is going to go up drastically. But when the country is operating at below the full employment, yes, it is going to increase the employment opportunities. It is going to increase the real GDP along with the inflation. Better off. And even private investments can get crowded out. So the investments are going down. So aggregate demand can very well fall. And if the economic activity is slower because of a supply but not due to a demand, even further, even if expansionary monetary policy expansionary fiscal policy is taken up, it is nowhere an appropriate thing at all. Even any fiscal policy will become dangerous. See, if I look at it, if the supply is a problem, it's already operating at lesser employment, right? The employment levels, the real GDP has gone down, inflation has gone up, and let's say now the government has come out with a contractionary monetary policy. Forget about expansionary. Let's say it has come out with a contractionary fiscal policy. The aggregate demand has to shift to the right, which is resulting in even further reducing the employment levels in the country. Though it has controlled the inflation, the economic activity has gone quite worse. Look at the expansionary policy. At least in that case, in the expansionary policy, the prices have gone even more higher, though the employment levels have come back. So the inflation is going more and more, and it can even go to such an extent that the economy is completely dull. And if the budget deficit is very high, funding it is a very big difficulty. The interest rates can go up drastically, right? And especially if the country is having multiple targets, high employment as well as high inflation, both of them cannot be targeted together. So there are so many ways, there are so many reasons why a fiscal policy that is implemented in a country really may not be successful. So many difficulties that can come out with the implementation of the fiscal policy. And just to summarize, just looking at combinations of fiscal policy and a monetary policy, let's assume that the fiscal policy and monetary policy both are contractionary. So a contractionary monetary policy will result in interest rates which are higher. Contractionary monetary policy resulting in the interest rates higher, whereas expansionary monetary policy is going to reduce the interest rates. So this relationship is clear. Then expansionary monetary policy, is resulting in the output wise, if we are seeing, or let's look at the fiscal policy. Expansionary fiscal policy is resulting in the aggregate demand curve shifting to the right. So in any expansionary fiscal policy, we see that the output is increasing, even the prices are increasing. So inflation is increasing, the output is also increasing. So with an expansionary fiscal policy, I see that the output is higher, and with a contractionary monetary policy, the output is lower. This I will come back. With an expansionary monetary policy, right now we could see expansionary monetary and contractionary fiscal. Contractionary fiscal is right, a contractionary fiscal policy is reducing the output, whereas expansionary monetary is increasing the output, because when the monetary policy is expanded, we see that aggregate demand is shifting to the right, because an expansionary monetary policy is reducing the interest rates, and if the interest rates are reduced, obviously consumption is going to go up, investment is going to go up, aggregate demand is going to shift to the right. So the contractionary fiscal policy is pulling the aggregate demand down, whereas expansionary monetary policy is pulling the aggregate demand up. So that's where we don't know whether the output is going to be lower or higher. That is the reason we said it can vary depending on how tight the fiscal policy is and how expansionary the monetary policy is. Then coming to the public sector spending, government spending. So we know that the government spending is much higher in case of expansionary fiscal policy and lesser in case of a contractionary fiscal policy. So we see a direct relationship here. Whereas the private sector spending is purely coming out from the monetary policy. If the monetary policy is contractionary, right, or expansionary, if it is an expansionary monetary policy, we have seen that the investments are going to go up, because the interest rates are going to go down, the investments are going to go up. The private investments are going to be higher, which is resulting in a private spending higher, and the public spending, and in case of a contractionary monetary policy, the private spending is much lesser. So what we have to really develop as a good understanding of this monetary and fiscal policies is what kind of policy is going to have what kind of impact on the economic activity, on the inflation, on the spending by the government, on the interest rate, on the prices, on various economic variables, right?